we're streaming, so I'm just going to wait for this to turn on here. We need an intro song or a little ditty or something. Okay, guys, we're loading up here, and welcome back. We are live to the Trade Ideas Back to Basics for, I think this is number 10. So today we're going to go through more of fundamental analysis, and, oh, that just closed all of that. 1 second, guys. I apologize. Okay, that should be better now. Sorry about that. So yeah, this is number 10 of the Back to Basics series, where we start to go through basically this. Okay, so we go through from the very beginnings of trading with some trade ideas people we have with us to kind of the more advanced topics where we're going to talk about technical and statistical analysis. We're going to go through machine learning and auto trading and all these crazy things. But today we're talking more about the fundamental side of things, where we're going to go over last week. Again, if you guys miss any of these, if you're new to the series, you can go back on the channel. There's a playlist right at the top of our YouTube that goes through everything in order. Last week we went through, let's go here. We went through the beginning of fundamental analysis. So what was it, the uses and the limitations of it? So essentially, fundamental analysis, for anybody who's interested, is just a form of analysis that instead of using charts or statistics, it uses what is the company doing, what is actually their business model, what are they selling, what industry are they in, this type of thing. Talked about why as traders we focus more on the charts, but why there's some certain things that are very important to realize and to use when it comes to fundamental analysis. And today we're going to talk about specifically what are these things and how we use them in the trading. So, again, if you missed last week, go check it out. It's talking about the whole grand scheme of thing and how a lot of these numbers are derived. We'll briefly go over that with each number again, but then we'll talk about more of how you use it in trading. So we'll just move us here. So essentially, we're talking about where to focus, right? This is the biggest thing. So, we've had questions throughout of, there's chart patterns everywhere. There's stocks always moving. There's, any chart pattern you can come up with, you can find hundreds of them all throughout the market. So where do you focus? And this is where I think where fundamental analysis shines, is there certain things that we can say we want to be looking here, and this is the reason behind why we want to be looking here. And this is going to be basically a two-part. So we're going to do a bit of it today, and then we're going to do a bit of it next week as well. So we're going to talk about volume, relative volume, which is going to take a large breadth of it because it's very important. Spread, float, and short interest. So again, all of things that we covered last week, but we're going to talk about a little bit more. So I've actually marked up the charts a bit here. Hopefully this will make things a little bit easier. But when we're talking about volume, what are we talking about and why is it important? So way back when we talked about market mechanics and how market moves and bid and ask spread, we talked about the fact that just because you see a price out there doesn't mean you'll get that price. If the stock's trading at $10 and you go send out an order and say, I want to get in, it doesn't mean that that's necessarily where the buyers and the sellers are. It means that's where the last trade occurred. So what you're going to find is the more volume that you see in a stock, the closer you're going to get to whatever that last price is, because the more trading is going through. And the more trading that's going through, the less your trading is going to matter. If, for example, you're trying to buy 100 shares of a company that's traded 500 shares today, well, you're 1/5 of the volume of the entire stock. So the people that are bidding and offering, and we'll talk about spread later, are going to be very wide apart. And the price you're going to pay is going to be a lot higher than kind of the one you see on paper. So, when you look for stocks, you want to look depending on your size. So say you're trading 5 shares. Well, volume is not going to be as important to you. If you want to buy 1,000 shares of a stock, volume is going to be much more important because you're going to be a bigger percentage of what happens. So I'm just showing here on Trade Ideas how you can see all these statistics and information before you enter the stock. So for example, BBY is Best Buy, right? We all know what Best Buy is and what they do. And this is just a snapshot taken, I think, this morning that shows 4 million shares were traded yesterday. So you can just look at that and say, okay, if I'm trying to buy 100 shares, trying to get in, trying to get out, 4 million shares is a whole lot of 100 share trades, right? So it doesn't really matter how much you're going to buy. I could go in with 1,000 shares and I'm not really going to touch the price because it just trades so liquidly and so heavy. But if you come across this and you see a number like 5,000 and you want to buy a couple hundred shares, you know you're going to be a bigger percentage of what the market is. So here at this, the rightmost arrow, we see the volume that it's done today. And here in the arrow that's a little bit lower, we see the average volume. So on average, Best Buy does 3.3 million shares a day. So you can build your scans in Trade Ideas when you're looking for your technical patterns. And this is where I want you guys to focus when it comes to fundamental data and say, okay, well, but I don't want to see anything that doesn't trade, right? Let's get rid of all stocks that just do like a couple hundred shares a day. There's tons of them out there, stocks that people aren't interested in, they're not talking about. So the setup might look really good, but you're going to pay so much more to get in and so much more to get out that there's going to be a problem. The next thing to do with volume is this histogram that you see on the bottom. And you've probably seen this on a lot of charts and may have known what it's about or maybe not, but each of these histogram bars corresponds with a daily bar up top here. And what it's doing is it's showing you the volume each and every day. So you can see visually very easily, is doing a lot of volume compared to where it is? Is volume increasing or decreasing? These are things that you might bring into your trading where quite often people will say that as a move is exhausting, volume will start to decline. And as a move is starting, volume will start to rally because people are starting to get interested in the stock. So they're going to come in and trade the stock, and that's going to move the stock as well.
Are you saying that you're better off trading companies that have lower volume?
This is the other thing. So the more volume in a stock, the more it's going to take to move the stock. So whereas I said my 1,000 shares on Best Buy would be a drop of sand on the beach, right? It wouldn't matter. That also means that it's going to take 1 million, 2 million shares to come in behind me to move the stock higher. So
okay.
So what you need to do is you need to compare the size that you are trading to the volume, right? So if you want to buy 10,000 shares because it's a $1 stock and you want to put 10 grand into it, and it's only doing 10,000 shares that day, you're going to cause this huge spike in the stock, and you're going to be one of the ones that is getting ticked out at the top there. But if you're just trying to trade 100 shares, it's not going to matter as much, right? So it's got to be tailored to your size. The other thing to keep in mind is if you're a big bank or a hedge fund or some sort of big institution like that, you can't trade those 10 share stocks because you would never be able to get in big enough to be worth it, right? You just wouldn't be able to trade it. The other thing that I forgot to note, and I will quickly, I do have the chat up here at the top, so if you have any questions as things go by or comments, just certainly let me know. Now with volume comes RELVol, but just stands for relative volume. So what this does, and this is in Trade Ideas right here where this red arrow is, it takes how much volume the stock normally does, and it shows you how much it's doing on that time of day today. So for example, if it's the market opens 9:30 Eastern, right? So it's 10 o'clock Eastern, and normally 10 o'clock Eastern, say the stock has done 1 million shares, but today at 10 o'clock Eastern, it's done 5 million shares. Well, that would be a relative volume of 5, right? So it's doing 5 times today at this time what it's normally done at this time in the past. And the reason this is important is because some stocks do a lot of volume all the time. Apple does tens of millions, hundreds of millions of shares every single day, regardless of whether there's news or there's not news. Doesn't matter. Hundreds of millions of shares every day. A stock like this that I'm showing you here did 48 million shares today, where it normally does 7 million shares, right? So it's got 9 times its normal volume. So that can be important just to show you stocks that people actually care about today versus where they cared about in the past, right? For some reason, and you can see down here on this little histogram how much more volume it's done based on normal days, is right. People are very interested. Something happened, earnings, news, something has come out on this stock. So when you're looking for your technical patterns, it might be a very worthwhile to go and sort by relative volume and say, okay, this is a technical pattern I'm interested in, and a lot of people care about it. And if a lot of people care about it, then it could push, there's more people out there to push the price of the stock more than it normally goes.
And this one's because I think, this must be from today. I think Avon sold this morning.
Yeah, there was some news going on with some sort of a merger. It actually opened up. You can see here the price was 401. So closed at 349, opened at 401. It actually sold off all day. But I was looking at this stock because I have scanners and trade ideas. It says, show me not what's doing the most volume. Because again, Apple would always be near the top, and then Amazon and Google, they would all be up there every single day, which is not interesting to me. I want the ones that are normally at the bottom and are now spiking up for some reason, right? There's something going on. And a lot of people ask in trade ideas, do we have news? And the answer is no, because we don't find a lot of value to news, although that is a topic that we're going to cover. But this is my news, right? I know there's something going on in this stock because 10 times the amount of people are interested in it today as yesterday, right? So I can go through and I can find the news online after that. So next is spread. So this goes back to liquidity, right? We want to make sure that if the stock is trading at $10 and I go send my order, that I'm going to get around $10 because that's my technical pattern. That's what I've seen on the chart. That's the reason for my entry, right? So if I go and I want to buy at $10 and I get filled at 11, well, I've lost 10%, right? Just right off the bat from where I want it to get in to where it got in, 10% out the window. So in trade ideas, we do have a spread filter. And if you guys remember spread from way, way back when we started talking about order entry, and I showed you guys that level 2 that had the bids on one side and the offers on the other. And I said, the only way a trade takes place is someone crosses one side or the other. So what the spread is essentially the ask minus the bid, right? So if people are offering the stocks at $10.25 and they're bidding for it at $10, that has a 25-cent spread. So that whatever price you're quoted, you're probably going to get 25 cents worse. And when it come time to sell, whatever you're quoted, you're probably going to get 25 cents worse, right? It happens on both ends. So I just brought up Google here, which is a very expensive stock, right? It's an $1,100 stock, but the spread here was $8.75. So right now it's quoted to me at $1,150. So I know that if I go send out an order right now to buy, I'm probably going to get $4 to $8 higher than that. And then if I immediately want to turn around and sell it, I'm going to get $8.75 less, right? Because you're buying on the offer, and then if you want to immediately sell, you have to sell to the bid, right? So when I buy and I get filled here, if I want to turn around and sell, I need to sell here, right? So that difference is the spread. So you always need to keep in mind that that's kind of what you can lose if you instantly want to trade, right?
That's a really high spread, though, because their stock price is so high, right?
Exactly, yeah.
Oh, yeah, okay.
So if you look at it on a percentage basis, it's actually not that bad. A stock, for example, like if we go back to, did I cover them up with the arrows? Yeah, I did. a stock like Best Buy, for example, will have like a 1 or 2 cent spread. Avon will have a 1 or 2 cent spread. And it's because they're cheaper stocks, so they're tighter in nature. Generally speaking, spread and volume are going to be related. The more volume you have, the tighter spread that you have, just because there's more active traders. So, for example, if the stock never traded and it's a $10 stock, I might go myself and say, okay, well, I'll buy it for $9.75 and I'll sell it for $10.25 and maybe just make 50 cents over and over again playing both sides. But if the stock is traded actively enough, I won't get away with that, because the second I do that, someone's going to come and front run me, and then someone's going to come and front run him. So the more active the stock is, the tighter you'll find the spread overall. So yeah, very important when it comes to trading. So it's kind of, and this is all going to be in your trading plan. There's going to be a checklist where you're going to sit down, you're going to say, okay, what's the relative volume, or what's the volume? Like, why am I interested in this stock in particular? And then you'll say, okay, well, what's the spread? Is the spread crazy, right? You'll just go down this checklist just to make sure that these things aren't going to hurt you before you get into the trade. So these are all things that you check, because you can't really control them kind of once you're in there. So next is float. And I'm sure we've all heard about low floaters and all this kind of stuff. So essentially, the float, which we talked about last time, is the amount of shares outstanding. And we use the example that, there's 5 of us here. If we opened up a company and we had each bought a share, so we had an even split, there'd be 5 shares outstanding. And that's our float, right? And then we talked about the fact that the lower the float, the easier it is to buy more of the company. So I found this penny stock, and I certainly won't encourage you to trade penny stocks, but the float of this stock that's trading at 75 cents, let's just call it $1 for my easy math, is about 7 million. So if I had $7 million, I could come along and buy this entire company, right? So the reason a lot of people like lower float stocks is because less money is required to move them. I could buy the whole company for $7 million. So if that's the case, then everybody who trades the stock is going to have more of an impact. And that can be a bit of a double-edged sword, because you're going to cause a nice spike with it, but then you're also going to cause a drop if it happens the other way. So your moves both ways are going to happen much quicker, because much less money is involved to move them. So it's important to know the float, so you know kind of what you expect. Again, back to the Apple example, has a massive float. I don't even know, but it's 100 million shares, and it's an expensive stock. So therefore, $7 million, I could dump $7 million into Apple, probably wouldn't do much of anything, right? Whereas this, it's going to be a little bit different there. So again, it's your trading decisions are going to happen based off of statistical analysis when we start going through back testing and all that, and technical analysis. What fundamental analysis is going to do is it's going to make sure that you're really not getting burnt too much in different stocks, and that there's a reason to be looking at this. Like, for example, the relative volume in this is 1.53. So, it's doing like 150% normal volume, which is interesting, right? Something probably happened. There was probably some minor news, but it wasn't that impactful. Whereas the other one was doing 10 times normal volume, so it'd be a lot more impactful. So again, fundamental is going to say, I like this technical pattern. I've back tested it. I know that this is something that has the potential to make me money. And then you might go in and say, oh yeah, but it only does 20,000 shares in volume, and that's just not enough for me. Or the spread is huge, and that's not enough for me. So it will be a way to get you out of things so that you're not getting hurt. Because again, the worst thing in trading, and I've had it happen a whole bunch, is being right, but not being able to get the fills you want, right? You see the stock at $10, you say, I want to buy it at $10. You instantly get filled at like 10.30 or 10.40. And then you try to get out, and you get out at 9.80 or something. So you just lost 50 cents, but you were right when you look back at it and the stock did move in your direction, it just wouldn't have moved enough that you could have made any money off it, right? And that's the worst thing. It's hard enough to trade. And so when you get to the point where you're right, but you just couldn't get the fills you want, it's absolutely infuriating. So then with float comes short float. So we talked about last time how there is the float is the number of shares outstanding, and the short float is the number of people who have shorted that, so have bet against that stock. So, for example, this stock in particular, Emphasize Energy, Enphase Energy. Kid, gotta get new glasses. 25% of all of the shares outstanding are short. So there's 100 million shares thereabout outstanding. 25 million of those shares are short. So then we talked about when we went through the brokers and the exchanges and that mechanics, that for me to short a stock, I have to go to my broker and I have to say, I want to borrow those shares. The broker will, okay, here's the shares. You're going to pay me a small interest fee every night that you hold them. But then you owe me my shares back, regardless of what the price is, whether it's, it's right now it's trading at 15. Doesn't matter whether it's 25 or 10. You have to buy those shares back at some point and give them to me. So the question is, at what point do I have to buy those shares back? And what I have to buy those shares back when the stock is moving up and my account runs out of money. So if I have 10 grand in the account and I short a bunch of shares, and then all of a sudden for me to buy back the stock, it's going to cost that entire $10,000 that I have in my account. The broker is going to force me there to buy the stocks back. They're going to say, you have to buy them right now, because if they move any higher, you don't have the money to buy my shares and give them back to me. So what that does, it creates a short squeeze. If enough people get their broker saying, you have to buy those shares back right now, it causes forced buying, right? So when a stock moves higher, and then all of a sudden the broker gets on the phone and says, give me my shares back, go buy them, they have to buy them. That's going to cause a short squeeze, which is going to push the price higher. It's shorting that has to be done. They can't argue about price. They can't try to get a good fill. They can't wait for a pullback. They have to buy right now. So Steve Gomez... Sorry.
Short squeeze happen a lot or no?
Happens a lot. Steve, basically, that's one of the thing that I'll show you guys in Trade Ideas after this is his channel, which is all about short squeezes. This is what he looks for, these kind of stocks, where he knows that if this stock has any sort of good earnings because it's right on highs or pops up higher, there's going to be a lot of this forced buying, and he basically makes money off the pain and misery of others, as bad as it sounds, but that's the market, right? So in Trade Ideas, we can talk about the short float as percentage, but then we also have here days to, and it's cut off, but this is days to cover. So what that does is it takes the amount of shares that are short and then the amount of volume that goes through and says, if everybody has to buy the stock back, if every print of the stock is someone to say, okay, I need to buy my shares back to give to the broker, how many days will that take, right? So the average volume of this is 2.5 million shares, and we know there's 25 million shares outstanding. So it's going to take 10 days of consistent buying at the current volume rates for people to get out of their shorts. So that's huge, right? So this number is reported twice a month. So that's important to note. We're actually working with a data vendor to get kind of an estimate done more frequently and in real time. But with 10 days required to cover and the stock on highs, that might be part of your trading plan. You might like the sound of that, where this forced buying is going to be something that you're interested in. So this is something else that you would use technical analysis for. You could build a scan, and I'll show you a channel we have pre-built. It says, only show me stocks that have really, really high days to cover, that it was going to take a long time to cover. And then I'm going to take that list, and then I'm going to scan for all of the technical patterns that I was taught. Maybe you would have bought in, this bull flag that happened here, or there was another bull flag that happened here. So you're taking the fundamental data, you're using that to scan the market, and then you're using your eye as a trader to find the technical data. So yeah, this is one that's used a fair amount. So that's it for the educational, the sheet anyway. Again, you can find me at Bonpar on Twitter and Bonpar on YouTube. So was there any questions with any of that? Both the chat and you guys? Or did we get everything along the way? I think we got everything along the way. But I am going to show you. Here is trade ideas. Let's get this out of the way here and move us over here. And yeah, so this is a channel built in. So you buy the program, you open it up, you're presented with a view like this, and you can scroll down to short squeeze. It's a picture of a guy squeezing an orange. And there's some pre-built scans. So this is kind of going to be your homework for this week, where throughout the day this is populated with different stocks, and this window here is showing stocks that have high short floats but are moving right now, right? So this is going to be updated more frequently than the stuff that I got you do before, which was just scan it every night. This will be happening kind of live intraday, and this is on the web version and on the other one. So again, what I want you to do is I want you to look at this every now and then, find some stocks that are interested to you and track them. You know, for example, you can see I was shorting the hell out of Tesla here. But yeah, you might look at Tesla and say, okay, well, it has a high short float. It's 30% short, you know, and then you look at it and you say, okay, well, it does 26 million shares today. And that's, you know, 2.5 times what it normally does. That's pretty significant. The spread's not on here, but I can show you guys how to add that. But then you look at the chart, right? And this is not a healthy stock at all, right? It's getting beaten up. So you say, okay, you might go, okay, on to the next one, until you find something that has an interesting short float, an interesting amount of volume, and then has some sort of setup that you're interested in. And then I want you to track that particular stock. And the cool thing about this is kind of happening, ticking live throughout the day, as opposed to just this static screen, which is kind of this one down here, which is just kind of sorting the market by certain things. So that is going to be your homework. As we develop, if you don't know, Trade Ideas is developing its own paper trading system within the software. Hoping that's going to be done fairly soon so we can actually get you guys paper trading these. But for now, just old school. The reason we call it paper trading is because before computers, people would have to write down with a pen and a piece of paper. I would have bought it here, my stop was here, my target was here, and then check on it in a few days and see which of those was triggered and how much money in paper they would have made. So that's kind of where the origins of that came from. So yeah, so there's nothing to share with you guys this week. Again, just open up your channel bar and just go to short squeeze and you'll find it there. So one more chance for questions. We actually finished 2 minutes early today, which is fantastic. Usually we're way late. So anything? Bueller? Chat? No? Okay. All right, guys. With that being said, I'm going to shut everything down, and I'll see you guys next week. Wave, everybody. Bye.